So let's connect with Neelkanth Mishra, India equity strategist with Credit Suisse, who joins us live from Singapore. Neelkanth, good to have you back on ET Now. Thank you for joining us. Let's first talk about the broader big picture. And the broader big picture is that India is the best performing market in the entire emerging market space. How would you map the current market setup?
Yeah, well, the emerging market space is not really the best benchmark. I mean, if you're looking at many other markets, look at Russia, look at Brazil, you look at China, many other emerging markets are not really in the best of shape. India, on the other hand, has had a very welcome change in government. We've seen growth bottoming out. We've seen the currency stabilize for the right reasons. And therefore, we have to look at the market with respect to other economies the world over which have done well. So if you look at MSCI India's PE, the price to earnings ratio, and its premium over MSCI World PE, there's not been too much of an improvement. There's, I think, a 4-5% improvement in the last run-up. So what we are seeing in India is more or less a reflection of what's happening the world over in terms of asset prices, wherein I think the easy liquidity environment has pushed down junk bond yields. You've seen what's happened to the US Treasuries. We all expected beginning of the year that the yields would be upwards of 3%. Now they're back to 2.5%, whatever be the reason. And then you look at other emerging markets as well, where there's not been much of a change in regime. There hasn't been any improvement in the current account, and those markets are also up. I mean, they're not up as much as India, but they're also up. So that's one very big factor, the global return of risk appetite, the fact that asset prices globally are going up is also something that has helped India. I think the second factor that is helping India is that the economy has bottomed out. And as you would expect, in any stock where if you had been seeing steady downgrades, so say going from 9.5% growth 3-4 years back, where very frustratingly everyone assumed that 8% growth over the next 10 years was a norm, then 8% became 7, then 6, then 5, and at 4.5% everyone gave up. Now things have indeed bottomed out, and at least we are looking at a 5% plus growth this year. When that happens, most investors and the market as a whole then struggle to understand whether they should be valuing the market on FY16 or FY15 or FY17 even. And so that turnaround usually bumps up PE multiples, and that's also helping India. It is not so much yet the change of government that's the excitement of excitement. So to answer the question that you started with, yes, I think that there is still enough room for PE multiples to keep going up, and given that the index earnings will still improve by 8 to 10% at least. The current numbers are too high. They will be downgrades, but we will see 8 to 10% growth in the index earnings. The broader market will move up very healthily even from here.
So, Neelkanth, what's the sense that you're getting? Is this all that you talked about in terms of the economic growth kicking in? Has the market already priced that in, or do you think there is significant upside from the current levels that we could see and within this year itself, the calendar year that is?
Right. So, one is that when you're looking at the broader market, I mean, very few people really invest in the Nifty or the Sensex, and I keep repeating that it's specific stocks and sectors where we need to invest. And I think there's enough room for upside in consumer discretionary names, in autos, even in staples, I would say. And plus, of course, there are the regular steady growers, IT and pharma, where I think earnings stability is there. The stocks haven't done much for the last 6 months, and there is enough growth over the next 2-3 years. So there is enough room for upside in those markets, in those sectors. There are sectors, however, like the PSUs, some of the mid caps, some of the over-leveraged companies, where there is a lot of froth. And that froth, I think, is completely unjustified. At least the pace of change that's going to come around because of the elections or the change in government is, I think, most likely going to disappoint the market. things are not going to change as rapidly as people think, because they cannot. I mean, these are very large, complex problems that the government has to solve. So that's where I think things are a bit frothy. But broadly for the market, see, 8-10% earnings growth I think is sustainable. It's been done when the economy was decelerating. So I think if you're taking a 3-year view on the market, then that's something that you should assume will keep happening. The broader PE multiple at about 15.5, 16 times can actually go to 18 times as well. If it happens in the next 6 months, then you have over the next 1 year maybe upside of 15 to 20% for the broader market.
Right.
If that does not happen, that's actually a more slow drag up, then it will take slightly longer.
Okay. Neelkanth, for the longest time you've argued on various forums that you're not a big fan of cyclicals in industrials. But now that economy is making a comeback, has your view changed?
Yeah, so we have been sort of calibrating that remark, the past 6-8 months, that we are not big fans of deep cyclicals, meaning late cycle cyclicals. We are, the first thing that turns around usually is autos, commercial vehicles, some consumer discretionary names, because this is where improvement in utilization drives a strong pickup in earnings. And that's something that we have continued to like. There are non-banking finance companies which are exposed to some of these sectors who are also beneficiaries of lower wholesale funding costs, and this is something we've been pushing for the last 6-8 months. And I think their sectors have done very well, and but I think there is still enough room for upside there. On the late cyclicals, so many of the industrial names, say exposed to the power capex or even there is power generation capex or metals or capex in even railways. I think the time taken for a pickup in orders and thereafter revenues and profits is going to be much longer than the market anticipates, and that's where the run-up has been very extreme, and that's where I think the risk of downside, or actually at least underperformance, is the highest. And I would include many of the banks in that category as well.
Neelkanth, you've got a positive overall view on cyclicals and high beta, but you have a negative view on Tata Steel and L&T. Why is that? The stocks have, doubled from the levels that they were at when the year kick-started.
Yeah, so they have been, and this is something that we've been flagging repeatedly in our notes, that look, even though the fundamentals are not going to change, whenever there is, and this is a note that where we crystallized it in March, where we showed that if the verdict was going to be strongly in favor of the NDA, and if the verdict was strong, the cyclicals would keep moving up at least till August. And given the verdict was much stronger than what anyone anticipated, and certainly not me, I think the upside can last for a few months longer. But if you're constructing a portfolio over the next 12 months so the perspective that you're giving was that there's not going to be any fundamental improvement in steel, in long cycle industrials, and that's a view that I still maintain. There's been no fundamental change on the ground. The Orissa mining disruption has sort of created some period of respite in terms of steel pricing, but once those mines are back up and running, even if partially, given the ore imports that are happening as well, I would expect that the pricing pressure will come back on in steel. And so I fully acknowledge that these stocks and some of these stocks have run up meaningfully, and they've gone against our recommendation. But when we recommend to our investors, we take a 12-month view as to whether you should be building on or either taking a tactical view or building core positions in some of these stocks. And I still believe that the pace of change and the earnings prospects going forward are negative.
Neelkanth, you said you're positive on banks as well. What is it that you're liking right now? Is it the private lot, the PSUs, or now would it be NBFCs, considering the RBI is now extending the scope of banking?
So we actually underweight financials. We like the private sector banks, the larger ones. We like the NBFCs, as you said, and we are underweight some of the private sector banks and most of the PSUs. Now, in particular NBFCs, as I said, I think the balance of payment surplus that India is likely to see for a while means that wholesale funding cost will remain low. And so despite the fact that RBI may not cut rates, the cost of funding, so the effective interest rates for some of these banks will go down. And they have no problem with loan demand. Whereas for the banking system as a whole, loan demand is going to be an issue because who's going to borrow? If the capex cycle takes much longer to recover, then I think loan demand is going to be an issue. Some people are becoming very constructive on banks in the hope that credit costs will come down, that at least the reported credit cost, and even in this quarter, given the large transfers to asset reconstruction companies, and the fact that kicking the ball down the road, kicking the can down the road is a favorite game in town. I think the reported earnings may not be as weak as what fundamentals would warrant. But I still think that those risks which are right now being forgotten, given the euphoria around the elections, in another 2 or 3 months you will see maybe after a week, September quarter number that you start to see in October, November. That's about the time that you see the disappointment in the banks start to come through. I mean, it may be too early. So as I said, I expected, even though my fundamental view on deep cyclicals is negative, we have been flagging that they will keep running up if the election results are good, and they have been. And so what is happening is entirely anticipated. Our call will start working most likely from October, November on when the fundamentals start to play out.
Fair point. Right now it's a rising tide which is taking everything up. Then soon boys would be separated from the men. Neelkanth, as a house, for the longest time you've recommended your clients that they should maintain an overweight stance on IT. Do you think TCS and Infosys numbers and the strong management commentary, has that endorsed your view further?
Yes, so we have been very, you just look at the size of TCS. I mean, generally I don't make stock-specific comments, but look at the size of TCS and look at the quarterly momentum that they've shown. I think, the CEO has been making remarks about the importance they place on agility, on not being bogged down by size. And I think these are remarkable changes. And, truth be told, I've been looking at the sector well, I've worked in the sector as well, and I've been looking at it for more than a decade. Now, at every stage, people thought that, 70,000, 100,000, 150,000, 200,000, 300,000, this is too large, it's too unwieldy, they can't keep growing at that pace, but they have managed to. And so that's been the only concern that I think has been meaningful among investors. The rest of it, that the rupee is going to appreciate. I don't think the RBI will allow it to appreciate, because I think the RBI understands very well that what's happening globally is competitive devaluation. I mean, we are not yet at the worst types of currency war situation, but there is clearly competitive devaluation happening. I think the governor himself has made a speech at the Brookings Institution where he highlighted how QE only works through the currency route. So what's happening in the US or in Europe, Japan's doing it, everyone is cutting interest rates. In this environment, you really want your currency to be appreciating. And I think so the currency is not going to appreciate. I think the worry about rising cost, that if inflation is very high, then the engineers will keep getting more expensive because you'll have to give them hikes. Well, guess what? That has not been necessary because there is an oversupply of engineers. And the arbitrage, the labor arbitrage that works between the US and India, that continues unabated. And given that technology is changing a lot, there is a need to keep investing for the customers in new technologies, on storage infrastructure, on social networking, the SMAP. So I think that thesis is still very much on, and I think it will continue to play out. I agree. I think the reinforcement from management has helped. Second half in general, as our analysts have been flagging,
right,
is usually a good time to be in IT.
Okay.
And I think there's another 3-4 months left for that kicker.
Okay. Neelkanth, final question. Do you think currently Indian markets are at a crossroad? Because for the moment there is strong visibility in IT and pharma, but from a 3-year perspective, the incremental growth will not come in IT, it will come in cyclicals and proxy economy related sectors.
You know, if you're looking at FY17, now let me give you the uncertainties. It is very easy for us at this stage to start thinking FY17, right? Because we know there's a strong government power with at least the right intentions and trying to veer away from corruption, trying to do the right thing for the economy. I think, and these are things that we should make us all very hopeful about the prospects over the next 5-10 years. The problem with pricing in FY17 at this stage for many of these sectors is that a lot of things can change. And what if India and China were to get close together? In China, the problem in China is that if you build 50 years of infrastructure in 10 years, then after those 10 years, it's not like rice or wheat you keep consuming every day, right? So you have to find use for that capacity, not just in steel or in cement, but also in terms of construction equipment, the construction teams that you built up and trained. Now, why can't those teams descend on India? Why can't they come to India? So if you're looking at FY17 as a time when a lot of construction activity will pick up, why can't that be done by Chinese companies, which are going to be more efficient than Indian companies? Now, there are going to be geopolitical issues, there will be political opposition, there will be lots of things that can change, but taking a 3-year view is very risky. So we are assuming that a certain direction will play out, and so if you are actually wanting to buy stocks on FY17, then you should be buying IT and pharma, because that's where the earnings delivery is actually reasonably more certain. We've often joked in the team how stocks in IT move on 0.1% and 0.5% earnings misses, whereas in metals and 5% change doesn't change anything at all.
Right.
In IT, that growth is far more certain, and therefore
right.
I would expect that those stock sectors would continue to be attractive.